Hi there, everybody. It's Lee Martinson here, the Customer Success Manager with Snap Projections. And I also have Anu with me today to be watching the questions that are coming in. Hopefully you guys will have a few for us to answer. I do have a little bit of information prepared as well. We can go over a little bit of a example case with a spouse and adding an RESP to the projections because we haven't really done one of those yet. So I thought that would be a good topic. And if you do have any questions, feel free to just type in the question window, any of your questions that you've got, and then we can hopefully address them right away. If you have any questions first, or if there's anything that you want us to address, feel free to type it in even now, and then we can go over that as well. So I think the first thing I'd just like to bring up is when we do the plans, again, some of the top 6 questions that your clients might have. And today we'll talk a little bit about how long will my money last and am I going to be okay? And maybe even talk about government benefits, which of my assets should I spend first, what they're currently saving and will that be enough? And really we can answer all these questions today when we look at the example that I've got set up. So I think the first thing, why don't we take a look at the example clients that I have. So let's make this bigger here. This is an example questionnaire that I've got filled out for an example couple. So if you were here a few weeks ago, we did an initial case for Jackson Peters, and he was just a single person and he had some questions about when he might be able to retire and how much he could save and spend in retirement. So today I thought, well, why don't we just add a spouse to his projections? And her name is Samantha. She was born the same year. And they've got a couple children that they're saving towards the RESP and the education for them. And their main goals are, can we afford to retire at 65? They want to have the same lifestyle as they currently are living in retirement. And they were planning to pay off their mortgage shortly, and they would like to provide their kids with 4 years of, looks like here, annual education cost of $22,000 a year for each of them. And I'm going to go over how we can enter that into the software. So I'll be looking at this on the side, and I'll enter in some information for Samantha. But basically, they're both working right now. Samantha also has a defined benefit pension plan, so we'll talk a little bit about that. Government benefits, what they're expecting to receive, what their assets currently are. So they both have RRSPs as well, some contribution room that's available to them, and non-registered account, just a little bank account, their house, their liabilities, a mortgage, and no insurance right now. And that's it. So it's pretty simple, but that'll give you a chance to ask any other questions that you might have as we go through. All right, so let's bring in Snap Projections here. So I think first thing, I always like to point out where you can get some help if you need it. So up at the top, we have our help center, we have our instant answers, and so on. And so make sure you can access this whenever you need some help, and we'll be more than happy to help you. So let's just go ahead then and add Samantha. All right, so her name is Samantha Peters, and she was born 1972, August 15th. And I'll just hit next to go to the next page. You can see that right there, it just saved for me automatically everything that I've just entered. So that's why I just have to hit next one more time to refresh, go to the next page here. They both want to retire at 65. We'll show projections until they're both 100. And I'm just going to use the same rates of return and inflation rates that I had set up previously. If you ever want to make changes to the defaults, you can go ahead and do that just by clicking the defaults at the bottom. And then you would say save the current page for new scenarios, or if it's something different than what you would typically use that is your saved settings, then you can just update it back to your saved settings or even to the original settings that were here when you first signed up with Snap. So that would be the guidelines up at the top. And those guidelines are from FP Canada. And clicking on this, what's this, you can see more information about those projection assumption guidelines. You can go to that website, and we're just about to update these guidelines. It's just the beginning of June right now, and they just came out recently. So with our next release, probably tomorrow or Friday, the newest FP Canada guidelines will be here. So if you click use guidelines, it will update with the brand new guidelines. Okay, so let's continue on here. So the next page, this is for Samantha. So I have the option of looking at Jackson or Samantha. Up at the top, you can see there are two buttons here. Samantha's is darker so that I can tell that I'm on her page. And then also I can tell I'm on her page by her name right here at the top. So her employment income is $70,000. And she also has a pension. So I just add that pension, DBPP, and it's starting at 65. So I can just jump over here to that box for after 65 years old and $35,000 a year with 80% survivor benefit, and it's indexed at 2%. If I wanted to prorate it and start it, after her date of birth that year when she turned 65, I can do that as well. And anywhere there's a question mark here, you can just hover over that and you'll be able to see more information. So we'll go to the next page, and here's Samantha's assets. So we'll go ahead and add her RSP. So she has $100,000, and I'm just typing in R for RSP. It automatically filled it in, or I can choose from the list here. And she's got this set up as 20% fixed income and 80% equity. If I know how much contribution room that she has for either RSPs or TFSAs, I can make adjustments here. So this was the default that set up for me. Where did it get the 12,600? Well, that was based on her $70,000 of employment income. So we're just estimating 18% of that as her room. But obviously that's just an estimate, and you can make changes and put in the exact amount. So she has, let's see here, contribution room. I forget what it said on the sheet. I'll give her 30,000. This will just let you automatically contribute up to that amount in the first year of the projections, and then it will track it going forward so that she won't over contribute. The TFSA contribution room, 6,000. If she's never had a TFSA, you can put as much as you want, up to 81,500 here for 2022. And I'll just save that for now because we're not entering any TFSA. So then a little bit of a trick here, because Jackson's information's already been entered into the plan, I can go to his non-registered account, and I could just indicate that it is a joint account, and that for real assets as well, the house, it is a joint asset. So if I switch back to Samantha, now we're going to see that she has those assets added to her page as well. So the next page is the debts page, and here it's a little bit of an automation for you because we made the house joint and the house was linked to this debt. It automatically made the debt joint for us as well. And then government benefits. For Samantha, she said that she expects to receive 75% of the maximum. So if I just enter 75% and I just click away from that, it will update for me automatically what her annual expected retirement pension amount would be. And this is going to be indexed at 2% until she reaches age 65. So on the planning page, it won't be exactly 13,310. It will be indexed by 2% until she reaches 65. Just a quick note about why originally it had said it was 56% of the maximum. That's just the starting point for everybody whenever you create a new plan, because we don't know what someone would be expected to receive for CPP. We're just giving them the national average. So for Samantha here, if I say 75%, then you can see that that's 19% higher than the national average. And because we're starting the government benefit here at 65, there's nothing I can change here. But if I was to start this later, so let's say 70, I can see that she would be getting a percent of the maximum is actually greater than the maximum she could get at 65 because she's waited to start it at 70. For now though, let's just make a baseline plan where we'll start it at 65 and continue from there. So OAS is default to the maximum already. I will leave that the same. And next step, we're skipping over insurance here. We don't have any insurance information, but for education, this is going to be the brand new section that we'll add in the RESP. So we can call this a family RESP, and they currently have $105,000 in this account. I'm going to specify that Jackson is the subscriber. So what that means is it will be the annual contributions to the RESP will be taken from his cash flow. Annual auto contributions. So do we want the software to automatically make contributions for us? And it will automatically calculate what the contribution would be to maximize the grant for any particular year, but it won't include any catch up on the grant. So if we want to have any catch up, we can manually increase the contribution later. But we'll start with the automatic and then we'll take a look at on the planning page if there's any adjustments that we need to make. Auto withdrawal. So this will only work if we enter in how much they expect that the education is going to cost each year. So as long as we enter that information, then SNAP will automatically withdraw that from the RESP in all those years where the kids are planning to be in school. Now that money that gets withdrawn is not going to affect Jackson and Samantha's plan because we know that it's going to the children for their education. So it shows a withdrawal, but it doesn't flow that money at all into the parents' plan. Okay, so let's add in the children here. So we have, let's see, let's do Kate first, and her birth year is 2002, 11/11, and so far she's already maxed out, claimed everything for the grant. We expect her education to be $22,000 a year at 5% inflation, starting at age 18 and for 4 years. So this is all editable by you. You know, the education cost I've included here, assuming that she maybe would be paying for some accommodation and maybe some food. But if you click on the how much does it cost, this is going to give you information about typical tuition prices. And I can show you that article right here. So I'm just going to go to help and our instant answers. And you can see based on the page that I'm on, so I'm on the RESP page, so the instant answers are showing me related articles for this page. So here's my guidelines for education cost. This is just a starting place for you, maybe to give you a little bit of an idea. It's from 2019, so it just gives you, like I said, a starting point. We haven't updated this every year. I can click on this little arrow to update it. And here's just different fields of study from Statistics Canada. So this is, there's a link here that you can actually go to this website yourself, but here's a little bit of a starting point for you. Okay, so the other two articles here are quite helpful as well. So tracking savings and withdrawals, and then frequently asked questions. We'll go over some of those as we get to the planning page. We'll add the second beneficiary. So this is their son. Josh was born in 2006 and the birth date was 12/01. And he has 6,000 of grant and same cost, let's say, for education, 5% inflation starting at 18 and 4 years. So that's the information for the RESP. Once I've saved that, you can see it gives me a little bit of information here in this table, how old the children are right now. We've set it up for automatically withdrawing, automatically contributing. And if I need to make changes, I would just click that pencil icon to do that. So let's jump out now here and we'll go up to the top. We have my scenario setup, which I've just basically finished. I don't need to enter anything else over here. So I'm just clicking planning pages to take me out to the planning page. So this is Jackson's page, and I can tell again because his name is highlighted here. And we also have combined pages when we have a spouse. So I'll take a look right there first just to show you how this looks. It's a summary page. The main thing that you're going to be doing on the combined page is going to be the spending amount. So when we had Jackson's original plan, he was only spending $35,000 a year. In this plan, what they had said is they wanted to maintain their lifestyle spending. So currently at age 50 in 2022, what's left over for the couple after they've paid their taxes and after they paid their debt, like anything else that's set up in the projections. So after RESP contributions, after any savings to their capital assets, and we'll go through and we'll enter some of this information as well. After any debt payments, what's left for them after tax is $102,000. So if we did want to say they want to maintain their current lifestyle expenses in retirement, then we would enter in that $102,000 here and copy it down. I'm just not quite at that point yet because I do know that, for example, Samantha had said she wants to make some contributions as well to her assets, and we haven't put those in yet. So it's the planning page where you're going to be entering annual savings contributions. So for Samantha, I can see that she's got her RSP and her the non-registered account that we said was joined. All of these years before retirement are zero contribution years. Why is it a zero? Like, what's happening in the plan? Basically, before retirement, SNAP is just assuming that they're going to spend whatever money is left over at the end of the year. And that's determined by this button here. It's called the CFM Start Age button, which is indicating right now at age 65, that's the year that we want to start automatic cash flow management. That's the year where we're going to enter a spending target and have the software withdraw money to reach that target. Before that year, we're not entering a spending target because many times people don't know what they're spending when they're working, but they do know what they're saving. So it's easier for most people to just enter what they want to save and then have the software assume that they spend the rest. Because if they're not saving it, they're spending it on something. So that's what we're going to assume. It just makes it a little bit easier to start with. So for our RRSP contributions for Samantha, she is making $6,000 contributions until she's 64. And I hit the check mark here. And this makes the background turn yellow. And that's just to highlight to me that I made a change. So the original values were zeros. I've made it 6,000. And now it's yellow to indicate that's a manual entry on my part. Since she also has a defined benefit pension plan, she is making like payroll deductions to that plan every year. So if we wanted to be a little bit more accurate on what's coming off of her paycheck, we can enter in here a negative amount for the DBPP, meaning that she's contributing to it each year. So here, for example, I could put in a 6,000 as a negative, which will mean it's an expense. Copy that down until the point where she starts taking her pension. And because it's in this column for the defined benefit pension plan, it will also reduce her taxable income by that amount. So if I look at, for example here, taxable income has this blue icon at the top. I can open up more details about that taxable income and how is that calculated. So here we can see her employment income, and then this other income, that was what we just put in as the defined benefit contribution. So it's reducing her taxable income by $6,000 due to that contribution. And also we're reducing her taxable income by her RSP contribution. And that's where we're ending up with our total at the end. The small amount of interest here, so this is due to her non-registered account because it's set up as a cash. Anything that's set up with cash and fixed income only is only going to generate interest. There's no equity allocation for that non-registered account, so we don't have any dividends or capital gains. Okay, so we've set that up. The other thing that you might want to do if you have a defined benefit pension plan and you want to make sure that clients are not over contributing to RSPs, there is a setup area that you can put in a pension adjustment. So for scenario setup, settings, and registered assets, this is where I can enter in a pension adjustment. And what this is going to tell me is that the RSP contribution every year will be reduced by whatever I enter here for the pension adjustment. And that will get indexed as well over time, just based on your inflation rate in your scenario. The pension adjustment for a defined contribution pension plan. So do not enter anything here if it's a defined contribution pension plan, because whatever they're saving every year into that DCPP will automatically reduce RSP room. So if you put a PA for a DCPP as well, you'll just be double counting that. So it's only for defined benefit pensions plans here. So I could say, I'm just guessing a number. I don't know what the actual pension adjustment would be, but I'm assuming something close to about $6,000. All right, so back to the planning page. So we're almost done here, those basic entries that we've done. Just take a quick look at Jackson's page as well to make sure that we've reviewed his income, $100,000 a year. He's making RSP contributions. And then over to the right, we can see this is where the family RESP shows up. So in those first couple years, the value of the account here is what's the total value of the RESP. Kate is already 2 years through her 4-year program. So we have her $22,000 education this year and next year, and then she's done. And we're making contributions for Josh. $2,500 each year is the automatic amount to get the $500 grant. If, for example, they were maybe saving a little bit more to get more catch up, we can enter that here just by clicking on it. So for example, I could say that they're saving $3,000 a year just for the first 2 years. And again, that becomes an override for me. And then I can run that scenario. So instead of getting a $500 grant, it's now $600 for the next couple of years. So once Josh starts going to school, it's withdrawing that $22,000 indexed with inflation. So it's $24,255 in the 3rd year here. And then it continues, but we can see that the cost, like the plan cost, $26,741 for his 3rd year. He doesn't quite have that much in the RESP. So they haven't saved quite enough to cover all 8 years of education for both kids. So the final year here, this $28,000 is really not covered at all. It can't withdraw anymore because we've zeroed out that RESP. So we'll talk a little bit more about what we can do in that situation, and would the couple plan to provide that income another way? So would they cover it from their RSPs? Would they save a bit more earlier on? So we'll do an example, and we'll show creating an additional expense for that final year of education. Before I do that, let's just come back to the combined page and take a look at what their current spending is. Now that I've added in those contributions, we went down from over $100,000 a year to what they're currently spending, about $93,175. So if they wanted to maintain that level of spending, I can just click on that retirement year and type it in. So let's try $93,000 a year. And we'll copy that down and run the scenario. And so this is just to answer their question, are we saving enough? Can we afford to retire at 65 and spend and maintain our lifestyle? So if I scroll down, spending $93,000 a year, I can see that age 86, there starts to be a shortfall. These pink years, shortfall pink years. This column here, the net cash flow, is telling me how short they are that given year. So in the first year, they're short 23,666. The next year, they're short by 54,000. So we're adding that on to the initial 23,666 and giving them a loan that's going to keep growing every year at a certain interest rate. And that loan continues down to the end where they're short by, they've had to borrow $1.18 million in order to maintain spending 93,000 indexed with inflation. If you do want to use this cash balance column as a debt column and you wanted to control that interest rate, under scenario setup and settings and advanced, this is where you can, oh no, actually, under settings and cash account, this is where you can control if there's a surplus and it was saving money to the cash account, it would be at a 2.3% interest rate, and then the borrowing rate is 4.3%. In most cases, we're going to try to avoid using that cash balance account. It's mainly to show you as a starting point how close are they to reaching their goals or not. All right, so then there's a couple more things that I can jump in and do with this plan, but I just want to stop here and see if there's any questions before I continue on. So I don't see any questions at this point, but yeah, if you guys have a question, go ahead and please ask. Okay. So next thing, they're not reaching their target retirement spending goal. So what are a few things that we can do? A couple problems. One, they're not reaching that goal, and two, they don't have quite enough to reach their goal of providing 4 years of education income for both kids. So the first thing that we could do probably would be to ask them, do you think you could make some additional savings into your, maybe we can create a TFSA for them at the beginning. So if I go back to scenario setup and assets, I'll create a TFSA account that has nothing in it to start with. And I'll use the same asset allocation here that they originally have. So this is for Jackson. And a quick tip is that you can click copy to spouse, and that will add the same asset to the other person. So instead of going to Samantha's page and typing it in again, it just shows up for me automatically. And then I can adjust it. Perhaps she's a little bit more aggressive here. She has a 20-80 split, and we'll update that as well. So here's that contribution room area. Because she has never had a TFSA, she's got the 81,500 of room for this year, and I could do the same for Jackson as well. So edit contribution room, 81,500. So that's the first step. We've created the account so that now back on the planning page, we're able to contribute to it each year. So here's my TFSA account for Jackson, and I'm going to put in, they think that between the two of them, they can contribute an extra $6,000 a year. So I'll copy that down to age 64 for him, and then I can just switch right over to Samantha and do the same thing. So this is probably a good point to point out to you guys that we're super excited because we're about to release a new recommendations feature. In the next few months, we're working on an automatic, calculation for you that will show you how close they are to their target spend and what they might need to save in order to reach that goal. So I'm here making up a number based on what they can afford to spend. So that's the good thing about doing it this way, is that you can have that discussion with your clients and say, what's reasonable? Or do you think you can afford an extra $6,000 a year of savings? Because if we just come up with a number and say, oh, you need to save another $20,000 a year and put that in, that might not even be reasonable for them. So this at least gives you a way to start with what they think they can do. So that will automatically save money then into a TFSA. So if I come back to my combine page, I can see how close I am two ways. One is I can scroll down again and see, oh, now they have, they don't run out of money till 91. Or we have the sustainable scenario feature, which just beside run scenario, I can choose run sustainable scenario. And I'm going to start at 65, which is retirement, and run the scenario. So instead of me typing in that they want to spend $93,000 a year, this is going to tell me what is that maximum spending so they don't run into a shortfall before the end of the projections. So we won't see any years of red. It will be a consistent spending throughout retirement that will basically zero out all of their capital assets by the end of the projections. So we've got the 88,109 as that consistent spend all the way down to the bottom here. So 88,109.
Lee, can
All
I
right.
jump in with a quick
Yeah,
question?
sure.
So yeah, there's a question where when we're looking at the planning and looking at the charts, and this might be like a recommendation somebody's asking. So do we meet the clients at this stage of the planning process and discuss the results in charts and spreadsheet form, or do we jump onto the reports to do that conversation?
So I think it's really like a personal choice. Like there's so many different ways that you could present this information. I do know a lot of people show their clients this and they work on it together and they say, what more could you spend or what more could you save? Or let's change this and let's run the projection and then we'll see it. But you need to be comfortable with the software to be able to do that. So it's understandable, like if you wanted to maybe create a couple of plans. So for example, the first one that I did before they saved the money, probably what I should do is if this hamburger menu up at the top, I can always choose copy scenario. And so you could present a couple different options after you've already completed them. So see the clients after you've kind of worked on it and say, here's my baseline scenario. So let's call this baseline, no additional savings, for example. And because I didn't save it before, what I'm going to do is just go back to their columns here and get rid of these savings. So we'll put it back how we had it. So it will just be copy down, clear override. So this clear override means take out what I entered there, those $3,000 a year. And we'll do the same here. Okay, and then we can have now two versions. So if I come to the combine page, that 88,109, which was doable when they made those additional savings, if I scroll down here, we'll see it is not. So what you could talk about with your clients here would be this estate before tax column has the little hamburger menu here at the top as well. So if I open that up, when you first open it, there's a button at the bottom that says compare. So I can click on that and I can see, so in this version, no additional savings. I'm running into a shortfall. Here's my debt by the end. This other one, I didn't have any debt, so it was zero. And then I can compare the final estate in that final year, so in 2072, or in any given year. I can click, let's say at age 65, so at retirement, what would you have saved by the time you retire in the version where we just do the RRSP savings, and then what would you have saved if you did RSP and TFSA? So there's any given year you can compare, and each scenario has its own report. So we can have your baseline scenario report, and you can choose as many pages as you wish to include. And then the version where you saved more, maybe you don't want to include as many pages, but you just want to include the assumptions that you're using and and include at the end perhaps the cash flow summary, and like, you can reduce the number of pages in the second report to make it a little bit easier to compare. The other thing I'll point out is if you go to help and let's say I'll go to instant answers here, so it'll just pop up here. If I search out webinar presentation. So there's this webinar we did. It is about a year old, but it's a great webinar because it talks all about using the planning page to present or using the report to present. And then in the report, what are the top charts that are really the most impactful for your clients? We did a survey to find out what advisors get feedback on, like what is the most important, I guess, what's the easiest pages to understand, what's the really most useful pages to present. And out of that survey, the answers were both the sources of income chart. So if I click here, sources of income, this is going to show in, well, any year, but in pre-retirement, it's pretty basic. You get your employment income, but post-retirement, what is your retirement income made up of? And this breaks down your pension income, RSPs, TFSAs, so on. Also shows you this tax line. So this pink line here is your taxes paid each year. And that's helpful when you're building the plan as well, because then you can start looking at, maybe it makes sense to change the order of the default withdrawals from SNAP, because what SNAP does by default is push the registered money withdrawals as far into the future as possible to maximize their cash flow early on. But that may not be within, your objectives or your client's objectives. So then we can make changes and compare, like, oh, how did this taxes paid line change? What did their final estate look like if we change the order? So I can show you as well how to do that. But yeah, that I would really recommend that webinar recording, because it goes into details about how to use these charts to present, because they are interactive. You can hover over the different headings here. You can remove them totally from the chart just by clicking on them. You can make this full screen. So if you're sitting with your clients in the office, or you have a big screen TV or something, you can make them full screen. Now this, I think because I have my screen on, I'm sharing it, it's not going full screen for a second, but it will go full screen. Go back to my planning page and show you. You can also access charts from this page. So charts up here. So you don't even have to go to the report first. You can just open it up here. And again, I could view in full screen, but I think it's because I'm sharing this screen through GoToWebinar. I've had this happen before where it just doesn't show on my full screen like it normally does. So a little quirk. Did that answer the question? Just take a second to have a glass of water here.
Yeah.
Yeah.
Yeah, well, I guess that answers the question. We have the response, so thanks for that.
Okay, perfect. All right, so yeah, guys, feel free to jump in, because I'm just talking out, making up what I want to talk about. But if it's not what you guys want to hear, then I'd love to gear this more towards what you want to know more about. So where did I leave off here? I think I talked about, oh, right. So RESPs. Let's go back to the planning page for Jackson, because this is where we can see the RESP is, we don't quite have enough. I'm just going to assume, because the final year is pretty close, 26,435 versus 741, we just want to cover that final year's $28,000 RESP cost, or what's missing in the RESP. So what's the education cost that we need to cover? Let's switch back to the other scenario. So if I say switch scenario, this will let me go back to the one where I actually did make the savings. So here I'm going to call this, just by clicking on the name, I can change the name. So this can be scenario 2, saving additional 3K per year to the TFSA and cover education cost. So when I save that, there's 2 stages here. So first is, come to assume that both Jackson and Samantha will cover 14,000 of that 28,000. So we'll kind of split it up. What she's doing, I'm on Jackson's page. So what she's doing right now is saving $3,000 to the TFSA that year. Let's assume he still makes a $3,000 TFSA contribution, but he also withdraws 14,000, I mean, to cover that education. So the difference then would be, it would be like he's withdrawing $11,000. So the contribution of 3 minus the 14 withdrawal would be a negative 11. So he's going to withdraw that, and we're going to do the same thing for Samantha. So that's the year he's 55, so 2027. So I'll go to Samantha's page in 2027 and do the same thing. So 2027, negative 11, and run the scenario. So that's the first step, because what we've done here, if I look at the combined page, it's a little bit more clear what's happening. What's left over for them to spend is shown in this after-tax spending real dollar column. In that year where I did that $14,000 withdrawal for both of them, you can see that their spending jumps up to $120,000. So that's, I can leave it like that, and we'll just know that out of that 120,000, 28 is going to the child for their education. Or if I didn't want to see such a big spike that year, it's a little bit confusing, like why are they spending so much that year? Then what I can do is add an expense to the plan. And how I do that is I go to the income page. So on Jackson and Samantha's page, I will add the same education expense. So this will be a 0 in the first year. It's only going to be in that 1 year that there's the expense. So I will put the amount as 0. I'm calling this the type of income is other. It's not actually an income, it's an expense. It's not taxable, meaning it does not affect their taxable income. And I want that for both spouses. So I can use this little green icon again and say copy to spouse. So what this has done is back on the planning page, I will have a new column and it's called education expense. It is under the income section, but what we're going to do is a negative income, which is an expense. So here I'll do that negative 14,000. And what this is basically doing is we're taking the 11,000 out and it's going to cover that $14,000 education expense. I could just make it, I mean, if it gets getting too confusing, you could just say it's $14,000 withdrawal and forget about the contribution that year. You can do that as well. It's just whatever makes it easy for you to understand. So Samantha's side, same thing. We'll also have that education expense under her column, and I will do that $14,000. So back to the combined page. By switching between the different pages, you'll notice that that run scenario button actually was red because I made a change, but it clears because switching between pages actually runs a scenario for me automatically. I can always just click it again if I want to make sure, but it has rerun that for me. And now the spending is more in line so that it doesn't look out of place that they've spent a lot more that year. So if I do look at the charts for those earlier years, down at the bottom here, this sources of income, it does show, I move my mouse out of the way, there's that little bar for the TFSA. So it's saying that there was a source of income at age 55 here with this TFSA withdrawal for both of them. So it was income because they took it out, but it went somewhere else to their kids.
Lee,
Okay,
just want to jump in for a
yeah,
quick question here. So,
go ahead.
when we're talking about the rate of returns, does the software automatically determine the rate of returns for RSPs and TFSA?
So for our ESPs, are you asking, or our
No, for RRSP and for TFSA.
yeah, so for RSP and TFSA, it's going to be dependent on what you enter under the assets page. So I guess two things. First of all, under the general page, there's your initial rates of return, which you enter as your defaults. So right now I've got 1, 2, and 5. So when I do go to the assets page and I say add a capital asset, those are filled in for me based on what I have under my general settings. So the 1, 2, and 5. I can change it here. I don't have to go back to the general page to change it. I can just change it right here if I want to. But it's then dependent on how you set this up. So if I said it was 100% cash, then my overall rate of return is going to be 2%. If I say it's 50, 50, then, well, again, these were the same. So, but it will be proportionate. So 50% is at a 1% rate of return, 50% is at a 2% rate of return. So my overall is 1.5%. So it just depended on how you allocate between cash, fixed income, and equity, and then what each of those has as their rate of return. Okay, so that's one thing. But then back on the planning page, those rates are filled in for you here. So for every year, you can see it's 3.5% overall for my RSP. But if I wanted to make a change, so I can click any year because they're blue, it's blue text. Anything on this page that's blue or purple, I can edit. So in this, well, probably would make more sense. Like at retirement, maybe they're changing up how this is invested or the asset allocation, and then I can make a change. And as soon as I change it in a future year, it will change for all years going forward. I can then change it back in a later year if I wanted to. Or I can also apply, if I've changed the asset mix, I can change that for all accounts, or I can also change rates of return for all personal accounts as well. The RESP is a little bit different. There is no setting in the education module to set the rate of return. By default, it gives you a 40% fixed income and 60% equity split. It does use your rates that were on the general page, but the 40-60 split comes just by default. But you, like I said, you can edit it. So if it was instead maybe 30-70, you can do that. So now it's going to be a 4.10% if I 4.1% if I click on it. That first year went yellow, and this means that I made a change there at the beginning, and it's 4.1% for all years going forward. Okay. So what we had done was save for education now. This couple years they're withdrawing money, and then they're continuing to save a bit more for their own retirement into the TFSA. And we had run that sustainable scenario, and it had been 88,109 before we made that education withdrawal. So I'm expecting there's a couple years here of shortfall because some of that money went to the kids' education. So what we would do then is rerun sustainable again. So starting at 65 again, it'll be a little bit less than 88,000. So they can spend 87,000. And it's funny, if we look up to the top, that's basically what they're spending right now. Like once we put in those additional savings, it brought down their after-tax spending right now as well. So now really it is pretty consistent, just happened that way, that they're maintaining their lifestyle in retirement with those additional TFSA savings. But there's could be other optimizations maybe you'd want to take a look at. And again, what I can do is copy that scenario, and we could look at maybe changing government benefit start age, for example. So if we look at, let's look at Jackson's page specifically. And right now, what the software is doing is based on this CFM order column. So right here, I can see pre-retirement, it's all dashes, meaning the software is not making any automatic contributions or withdrawals. So that's all based on our manual settings here of RSP and TFSA contributions. Then in retirement, if there was extra money, it would save it automatically to registered accounts, then TFSA, then non-registered. And then the reverse order is used for withdrawals. So non-registered, TFSA, and registered. And the reason it's doing that is to, like I mentioned before, it's maximizing their cash flow in those years until it has to start taking registered money. So you can see just Jackson's taxes are lower until he's depleted those non-reg and TFSA accounts, and then it has to take from the registered because there wasn't anything else to withdraw from. But one thing that you could note is that at age 65, they would be eligible to split any RIF income. So perhaps it would make sense. One thing to try would be, let's convert to a RIF at age 65 rather than at 70, like waiting to 71. So that's one thing I could do. So I could go to scenario setup and settings, and then registered assets. So here, the default RSP to RIF conversion age is 71, but I could change it to 64, which will mean the RIF will start at 65. So if I do that for both of them, perhaps this might make things a little better, but I don't know. We'll have to just try it out. So even without changing the order of withdrawal, so it's still going to take non-registered first, then TFSA, then registered, but because it has to take the minimum RIF income, that happens first. And if there's anything else needed, it will take from non-registered next, because what's ahead of non-registered in this list is mandatory RIF withdrawals. So then to see if, was that better, was that worse? I can, again, keeping that same spending that I had last time, I can scroll down. I don't see any pink years. So at the end, I can see, okay, they actually had $44,000 left in the RSP by changing that RIF conversion. So I guess, it was a little bit better in that they have a higher final estate, slightly. So then the question would be, these guys don't really have a lot of other money. It's just the TFSA is pretty small compared to, it's mostly registered money here that they need to deplete. But in other cases, it could make a significant difference if you try to switch it up and maybe take more registered money out first and leave the TFSA and non-registered till later. So we do give you that option. So if you did want to make that change, just to show you how you would do it, you can click that order, so that NTR, and by clicking on it, I get a little pop-up window, and from here I could make the change. So I could say, actually take registered first, then non-registered, then TFSA. Now here it's not going to make a big difference, but if I do this, I'll show you, I hit copy down, it will do it for both spouses. So you don't have a choice to change the order for each spouse individually. But by doing that, we can see instead of having any non-registered withdrawals, there's none. It's taking all from the registered first. And then again, I could look at combined and see how did that work out. Actually, it was worse in that they were short by 26. So these are really small numbers here, but just to give you an idea of what you can do there. So I'd go back probably and just change it to the regular order, which I can do on Jackson or Samantha's page. Another thing that we could do is delay the government benefits. So I can switch this back to non-registered TFSA, copy down. So just get it back to what I had. And this could be, again, at the top, renaming it. This could be just called earlier RIF withdrawals. And you can make these titles pretty long if you want to. Save that. And then again, I can make another copy if I want. And the reason I make copies is just that you can then get back to what you had before and you can compare. If you don't make a copy, that's fine, but you just won't be able to compare back to what you had before. So here I can go to government benefits, and then I could perhaps delay both even. I can take both at age 70, and they'll just have to cover with additional registered withdrawals in those years before they start getting the government benefits. And so again, I can change the name and
Lee,
yeah.
sorry about jumping in, but I know because we're a little short on time, wanted to squeeze this question in.
Sure.
Can you show a way on how to set an automatic annual withdrawal from RRSP and then put the money into a TFSA each year once a client retires in order to minimize the RIF amount at the age of 71?
Sure. Okay. So
Thanks.
I'll do that. Okay. So just to show you quickly, if I was to wait, do the later government benefits, then they ended up with more money at age 100 because they waited, but you could compare that at an earlier year as well, because obviously if they live longer, they both lived to 100, it made sense, but it might not if they only lived to, 80 or something like that. Okay, so that question, what I'm going to do is switch it back to 71 for the RIF. So under, again, registered asset settings, change this back to 71, do the same for her, and then go back to the planning page. So the first thing that you could do is just put a TFSA contribution. So if you wanted to maximize TFSA contributions, right now it's 6,000. So we'll just put 6,000 for now, but copy that down and run the scenario. There is a way if you put a higher amount that Snap will kind of increase it with $500 every few years, but in this case it's a little complicated because they had a bunch of room at the early years. They only were contributing 3,000 a year, so it's a little bit more complicated. So I won't do that one, but 6,000 a year going into the TFSA. Now, if you want that money to come out of the registered funds to do it, in this case, because that's pretty much all the money that they have, there is only this $10,000 in the non-registered. What it's doing is it's taking more out of the registered funds automatically to fund that TFSA contribution. So you don't really have to do anything to the RSP. It will just take more money out to cover that contribution. So what I would do the same thing on his page and put in 6,000, copy down and run. So again, because there isn't another account that you would need to worry about really, it's just this $10,000. And in that case, if I didn't, I didn't want that 10,000 to be withdrawn, then I could just put a 0, use the override to do that. This is telling me that there's a shortfall here at the end of the projection. So once that registered account is gone, I need to tell the software it's okay to withdraw money from this TFSA now that I've depleted the full registered account. So I would need to then clear, what we do is call clear the override later on. So when you do start putting overrides in the plan, it does tend to make things a little bit more complicated, and that's what you have to watch out for is, am I blocking the software from automatically taking money out of other accounts? So here it will start taking money out. And then the same I would do for the other person as well. So in this case, it won't, it only happened on the one spouse. And even though that they're out of money here in the registered account, it's still contributing here. And that's because it can use money here from the defined benefit pension plan, CPP, and OAS. But you might want to just even it out for both, so that in this case, this person is never going to withdraw from the TFSA, whereas all the money is coming from the other spouse's TFSA. So I would probably even it out so that they can both withdraw kind of more evenly, and then neither one of them ends up with a lot more money, when they're 100 years old. So in general, if you want to continue, maximizing your TFSA contributions, just continue that as an override, and then the software is going to pull the money from wherever the next asset would be. So if you wanted specifically it to come from registered, then you would want to make sure if you had other accounts that registered was the first withdrawal that was set up, the first order. But tends to be, a lot of people do like to put those contributions in, and then maybe, especially if they have a large non-registered account that they're trying to just transfer the money over from. So I think that's the end, unless there's another question there, Anu, but went over, yeah, quite a bit of information there.
No, actually, thanks for answering that, Lee. We don't have any other questions so far, so we're good.
We're good?
Oh,
Okay.
we
Yeah.
actually have one quick question if we still have time to
Yeah,
squeeze
sure.
that in. So, when we do these changes, does it affect the estate or estate summary that is less taxable income for the beneficiaries when we do the changes on drawing down the RSP?
Yeah, so then you can just take a look. Basically, in this one, we took more out, so we have more TFSA. So if I look at the state summary here, combined, you can see how much is left. I'm not sure what I had to compare back to, but you'd have to, yeah, you'd have to copy it and then do that change and then compare back.
Sounds good.
Okay. Well, thanks everybody. It's great to have your questions and great to have you come today. We have another webinar next week, which is really exciting on stress testing and the new functionality that's going to be available there and how you can make variable rates of return in your plans and so on. So hope to see you there. And then we'll have another one of these Q&A sessions the week after. So have a good day, everybody. Thanks for coming.
Thanks, Lee.